A very good afternoon to everyone. We are finally coming to our last chapter, that is the law relating to negotiable instruments for our fast track course. So let's start with the basics of this chapter. We are going to be studying about what a negotiable instrument is. In this chapter, we see three types of negotiable instruments, that is promissory note, checks and bills of exchange. And then we will be studying a lot of rules regarding negotiability, the types of checks, who are the parties to all of these instruments. We're going to be seeing how a check should be presented, what is the method of the banking system with respect to a check, etc. So let's start out with what is a negotiable instrument. As the word suggests, a negotiable instrument is an instrument, and the instrument is something that we have already seen under Indian Stamp Act, Indian Registration Act, as well as Stamp Act and Registration Act. What is a negotiable instrument? To negotiate means to transact with each other. So the word negotiable means, with respect to the instrument, means that an instrument is capable of being transacted between two or more persons. So a negotiable instrument can be seen as being transferred from one person to another for certain reasons. So we have three main negotiable instruments, that is a promissory note, a bill of exchange, as well as a check. So let's look at what does negotiability mean. The word negotiability, or for an instrument to be negotiable, they must satisfy the following conditions of negotiability. First and foremost, it must be freely transferable, because that is what makes it negotiable. That is what makes it capable of being transacted between two persons. Now, this method of transfer can happen through two methods. One is through delivery and one is through both endorsement as well as delivery. What do you mean by delivery? Delivery means to move it physically. So if I have to deliver a water bottle, then I have to take the water bottle and move it physically and hand it over to the other person, and that's when I say that this water bottle has been delivered to the other person. So that is okay to understand what do you mean by delivering. Now, what do you mean by endorsement and delivery? As we all already know, share certificates, the physical share certificates of a company, are capable of being transferred. Again, please note that I am only talking about physical share certificates over here, and I am not talking about the dematerialized versions of the same. What happens in a share certificate is that when a share certificate is being transferred, we do not issue a share certificate, a fresh one, in the name of the person who is buying the shares, but rather the share certificate will continue to hold the name of the person who it was given to in the very beginning. However, when some buyer is buying these shares, he will write his name at the back of the share by endorsing his signature. This is what we call as transfer by endorsement, in the sense that the instrument which shows or conveys the transfer between two persons with respect to shares of a company will not indicate the buyer's name or the seller's name. It will have the name of the person who was first given those shares. Now let's say, for example, the first subscriber to the memorandum received 100 shares from the company, or he has 100 shares. So when the share certificate is issued, it will be issued in the name of that person. But subsequently, those 100 shares have been transferred from A to B to C to D to E and etc. Now the share certificate will still be in the name of A, but then at the back of the share certificate, B would have signed as being the transferee. Then when it transferred from B to C, C's name will be there and his signature will be there, and it will continue so forth. So therefore, we are able to see that the share certificate shows the trail of who was the original owner and who is now the current owner. This method of transfer involves two parts. One is the physical act of signing on the share certificate. That is, B will have to sign, C will have to sign, D will have to sign, etc. And once they sign, is it sufficient if the share certificate continues to remain with A? No, it has to be physically taken and handed over to B. B has to hand it over to C. So there are two parts to this. There's an endorsement, which is also known as signing, and then there is delivery. Now apply the same concept to a very common negotiable instrument that we know about, a check. So what happens with a check? In a check, the transferee, the account holder will sign on it. Let's say a person gives me a check and they will sign on it and then they will have to deliver it to me. Can I call that as endorsement and delivery? Correct? So therefore, the first and most crucial element of negotiability is that it must be freely transferable. And if it is freely transferable, it must be transferred by delivery of those instruments or through endorsement as well as delivery. The person who receives it, the person who receives the negotiable instruments always obtains it in good faith if he has paid a consideration for it. If he does so in good faith and for consideration, then he gets it free from all defects and can sue in his own name. The holder has the right to transfer and the negotiability continues till maturity. What does this mean? For example, a check. A check is dated 1/6/2025. It is valid for a period of 6 months. So therefore, until it matures, that is till 1/12/2025, okay, the check will continue to have validity. So between this period, we can say that it can be freely transferred between any person. So whoever's holding the negotiable instrument has every right to transfer it, and he has every right to transfer it to another person who will get a good title to that negotiable instrument, provided he did it in good faith and he got it for a consideration. That is, he paid some kind of a money or valid consideration for the same. So what exactly is the effect of negotiability? We look at it from the concept where a person who's the owner is the only one who can pass a title to the next person. It follows this principle, nemo dat quod non habet or habeat. It states that no person can pass a better title than he himself has. So a thief can never pass a better title. Stolen goods will never have good title, with certain exceptions obviously. But with negotiable instruments, they're saying that in a negotiable instrument, the holder can pass a better title to the receiver. And the receiver gets this good title simply because it is a negotiable instrument. So only checks, promissory note, bills of exchange, etc. get the exception. So a transferee, a bona fide transferee, that is a person in good faith, received this negotiable instrument for a consideration without any notice of defect of title. That means he was not aware that there could be problem with the validity of the instrument. If he acquires the instrument free of defect, then he has acquired a better title than the transferor. This does not apply in the case of movable goods or even immovable property. However, for negotiable instruments, it does, the title does transfer. So let's look at some of the most important characteristics of negotiable instruments. The holder is always presumed to have a ownership in the property contained in it. It is freely transferable. A holder in due course gets the instruments free from all defects. We will shortly see who is a holder and a holder in due course. A holder in due course is entitled to sue in his own name. This is because he has now received ownership. And when a person gets ownership in or title, he even has the right to sue. An instrument is transferable till maturity, and we know that for checks it has validity for a period of 6 months. But if it is not a check, if it is a bill of exchange or a promissory note, then we can say that it will have a certain maturity period. Equal presumptions are given to all negotiable instruments until the contrary is proved. So the Negotiable Instruments Act provides certain presumptions under law, which the courts will have to may presume or shall presume until the opposite party proves otherwise. So this is an evidence related question. So these are your characteristics of negotiable instruments. Let's look at the different types of negotiable instruments. We have bearer instruments and order instruments. We have inland and foreign. We have demand instruments and time instruments. We have ambiguous and inchoate or incomplete instruments. What is a bearer instrument? A bearer instrument is a person who is holding an instrument and the amount of money payable is payable to the holder of the instrument. So if a person is merely holding a promissory note or holding a check, then we can say that the amount due under that promissory note or check should be payable to him. So if I am currently holding the bill of exchange in my hand, then I am the person entitled to the money. If I hand it over to my friend for safekeeping, I ask my friend to keep it for 10 minutes. Then for those 10 minutes, she becomes the bearer of the instrument and she is entitled to the payment. Hence, bearer instruments are payable to bearer. If it was, the requirement is that if the person's, if it is expressed to be payable to bearer, then it should be paid, or the last endorsement is in blank. That means there has been endorsement, so there has been a transferee who's holding the instrument. But then so many transfers have taken place that we are not aware of who is the last owner of the same. Then whoever picks up the check or the promissory note becomes the bearer of such instrument. Whereas order instruments are the exact opposite of bearer instruments. They are saying that a promissory note, bill of exchange or check is payable to order only. Payable to the order where it is expressed to be paid or to be paid to a particular person, and it does not clearly state that transfer is prohibited. So while bearer instruments is payable to bearer, order instruments is payable to order. Bearer is whoever is holding it. Order is basically whoever is given the instruction to, or who is, it's been clearly mentioned that it must be given to this person only. The next one is inland instruments. Inland instruments are those which are drawn by a resident in India, and it is drawn in India. It is drawn and made payable in India itself, or it is drawn in India and even made payable in a foreign country. The object is that it is drawn in India. Whereas foreign instruments are basically that which is not inland instruments. So it must be drawn outside of India and made payable outside India or even inside India. They are even saying that it must be drawn in India, made payable outside of India, and drawn on a person resident outside of India. So the category is, it is a resident, it is a non-resident person, it is a non-resident, but he has drawn the check in India, but it is made payable outside India. The next one is demand instruments and time instruments. Demand instruments are those which are, you have to demand for it. Only if you go present the promissory note or check will you actually get paid the amount of money. Until then, nobody will make any payment to you. But then time instruments are those which are fixed by some particular time, and that after a particular time it may even become invalid. So this is known as time instruments, which we can say is also the opposite of demand instruments. Ambiguous instruments are those which are to be treated as ambiguous by the holder itself. Now it says that where the person is a fictitious person or incompetent to contract, then whoever the holder is may treat that promissory note as ambiguous, as saying that it is it cannot be treated as a very valid instrument. Whereas inchoate instruments are those which are not written properly, are incomplete, or it is left blank and it is not addressed properly. So these are what we call as inchoate instruments, or those instruments which are not clear. So if it is not clear, then how exactly does one person expect to claim under it? The holder of a negotiable instrument is always presumed to be holding a proper instrument. But if the proper stamp duty is not paid, if it is left blank or it's incomplete, then it can be even treated as an invalid instrument. Let's now understand who a holder in due course is. Generally, we say that since a negotiable instrument is capable of being freely transferred, we can presume or we can understand that multiple persons can be involved in the process of this transfer. Now, A may be holding a promissory note, and this promissory note should be paid out to B. This promissory note should be paid out before 4/10/2024. Now, on a date, say maybe a date prior to 4/10/2024, B transfers this promissory note to C. So now, what is B doing over here? B is giving up his rights over here. Now, A will have to pay the money to C. Okay. B is who we call as the holder, and C is who we call as the holder in due course. Okay. So a holder in due course is someone who acquires a negotiable instrument before it becomes due for payment, that is before this date. Maybe this transaction could have happened on 1/3/2024. So it's due for payment only on 4/10/2024. Okay. So way before that, B transfers the negotiable instrument to C. So now A will have to make out a payment only to C. C becomes the holder in due course, and the holder in due course should have gotten the negotiable instrument for good faith and for a consideration. So assuming that the promissory note said that a payment of 5,000 rupees will be paid out on 4/10/2024. Now at this point, C would have paid a certain amount of money to get it from B, or he would have received it in good faith and consideration from B. Now A has to make the payment to C. Alright, now that we've understood what exactly is the effect of negotiability and the rules relating to negotiability, let's look at the different types of instruments. The first one is known as a promissory note. A promissory note is, a main thing is that it must be in writing, an instrument in writing, but it cannot be a banknote or it cannot be a currency note. Why? Because a banknote and a currency note is also a promissory note if you look at it in its real aspect. If I am holding a 10 rupee note, then it's saying that I promise to pay 10 rupees to the holder of this note. That is the value from currency. But when we are talking about promissory notes under the Negotiable Instruments Act, we are not talking about currencies. So other than currencies, it's any instrument in writing which must be an unconditional order. It must be signed by the maker himself, and the maker should pay a certain sum of money to the order of or to the bearer of any person. So the instrument can say, I promise to pay Arun a sum of 50,000 rupees. Then it can be paid out only to Arun. But then if it says the holder of this instrument is entitled to 50,000 rupees, then whoever is holding the instrument can come and claim 50,000 rupees from me. So let's understand who are the parties to a promissory note. There is the maker. The maker is the one who makes the promissory note, and he is the one who is promising to pay. So he will be the one who makes the payment of money. The payee is the one to whom the money is payable. And the holder can either be the payee himself or some other person that he transferred to. So let's look at it. A is the maker or the holder. He is the one who is promising to pay a certain amount of money to whom? To B. In this case, B is the payee and he is also the holder also. He is both. But then what B does is, B ends up transferring it to C. Now, if it gets transferred to C, B no longer becomes the payee. B originally will retain only the holder and C becomes the holder in due course. And he also becomes the payee because he is the one who is entitled to the actual money. Now we can say that between A and B, he is the maker and the holder. B was initially the holder as well as the payee, but then when he transferred it to C, C became the holder in due course and he also got the title of payee. So now A has to make the payment to C. This transaction, okay, is when it gets transferred from B to C, it can only happen through the process of endorsement and delivery. Whereas between A and B, there was only the requirement of delivery because it's the first transaction. It is the first transaction. A has signed, he has given it to B, the holder, and he simply needs to hand over the promissory note to the other person. Okay. But then when B is transferring to C, it's not sufficient that he simply delivers to C. He has to endorse on the same. B has to put his signature. B has to put his signature as well as C, and then it needs to be delivered. So between B and C, I can call B as the endorser and C as the endorsee. So apart from the maker, the payee and the holder, we also have the endorser and the endorsee in situations such as the one that we have seen in the example below. So this, my friends, is your parties to a promissory note. So let's break down the requirement and let's understand what are the essential requirements. The essential requirements is that it must be in writing. Oral promises are not considered as a proper promissory note. It must be an express condition to express undertaking to pay money, and it cannot simply be an acknowledgement of some debt. That's not enough. It must clearly say that I will pay out so much money to you on this date at this time. Okay. The promise should always be unconditional. You can never put a condition to it saying that I will pay you 50,000 rupees if you clear your exams. That becomes a conditional transaction and not a promissory note. The maker must be an existing person or a certain person who says that I oblige to pay so much money to you. The payee also must be certain who the money is being paid to and not some kind of a fictitious person or some other person. The person's name should clearly be mentioned over there unless it is a bearer promissory note. The sum payable must be capable of being certain and should not be subjected to additions, subtractions, clauses, etc. If 100 rupees is due, 100 rupees is due. If 10,000 is due, 10,000 is due. You cannot deduct charges from that amount and pay only the remaining amount. The transaction must always be in the legal money of that country. It must be properly stamped in accordance with our stamp law. And the instrument must contain the proper place, name and date on which it was made. So these, friends, are your essential requirements of a promissory note. Now let's come down to what is a bill of exchange. A bill of exchange is also a type of unconditional order in writing signed by the maker. So let's look at it. It is an instrument in writing. It must be unconditional and it must be signed by the maker. Directing a certain person to pay a certain amount of money to the order of or the bearer of the instrument. This is your most crucial element. Directing some third person to pay a sum of money to someone. Please remember, in promissory notes, the maker himself has to pay the money. It must be in writing, unconditional and signed by the maker. But then in bill of exchange, they are saying that I have to give an instrument in writing directing some third person, a stranger, to pay a certain amount of money to the payee. So a third person is involved in this transaction, and the rest of the rules apply just like it is a promissory note. So generally we will say that in promissory note the maker makes the payment himself, whereas in a bill of exchange a third person makes a payment. The parties to the bill of exchange are the drawer, the person who draws the bill. So before we go into the parties, let's just keep one item in mind, that is a check. Even though we will be studying about check as a separate topic in this chapter, a check is also a type of a bill of exchange. So let's keep a check in mind when we are looking at parties to a bill. How does a check work? Let's presume that we have an Arun and a Varun. Arun is transacting or has a bank account with ICICI Bank. He is a customer of ICICI Bank, and Varun is a customer of Kotak Bank. Okay. Now Arun wishes to make payment of money to Varun, and so Arun issues a check to Varun to the tune of 10 lakh rupees. Okay. So now what will Varun do? Varun will take the check, he will go hand it over to Kotak Bank. But remember, this check belongs to whom? This check is given by ICICI Bank only. So ICICI Bank is promising to pay some amount of money to Varun, Kotak Bank. But as soon as Arun issues the check, does the amount automatically get deducted from the bank account? No. Varun has to approach his bank and he has to deposit or encash the check. Correct? So this is what we call as acceptance of a check. He has to go and hand it over to Kotak Bank. Now Kotak Bank and ICICI Bank will communicate with each other. Kotak Bank will communicate with ICICI to check if Arun has the 10 lakh rupees in his account. If it is there in his account, then the money will get debited from Arun's account and it will get credited to Varun's account. Understood? So this is how our checks work. A check is also a type of bill of exchange. So now let's look at the parties to a bill of exchange while keeping a check in mind. The drawer is the person who draws the bill. We can say in this situation that it is Arun who draws the bill. The drawee is the person on whom the bill is drawn. We have Varun. The acceptor is the one who accepts the bill. So Varun can also be the acceptor. So the acceptor can be the drawee also, but it can also be the drawer himself, because we all know that if we go and give a check to the bank, we can itself withdraw money from our bank account. We can do NEFT transactions and RTGS transactions simply by using a check. So a check need not always be only to one person known as the drawee. The drawee can be the same person as the one accepting the check. However, a third person can also accept it on your behalf, or you can end up being the person who's drawing from your own check. Okay. So then next we have the payee. The payee is who the amount of money is payable to. So in this case the payee is Varun, because it is 10 lakh rupees that has to go to Varun only. The holder can be the original payee himself or any other person that the payee has endorsed. Now let's say that in this situation Varun has transferred the check to Ashok through a process of obviously endorsement. So in this case Varun, while being the original payee, has now made Ashok the original payee. I mean the payee. So now Varun has endorsed saying that Ashok is the one who is supposed to receive this amount. So when Ashok goes to present the check before his bank, he will sign at the back and then he can encash this check. Then we have the endorser and the endorsee. And lastly, we have two other types of parties known as drawee in case of need as well as acceptor for honor. A drawee case in case of need is usually introduced at the option of the drawer himself. Okay, who is the drawer? The person who is giving the check. Now there may be a requirement where there might be a chance where the drawer, while issuing the check, may believe that when the check gets encashed, the money may not be in his account. So he can actually have some person, that is a person he can introduce, saying that for the time being you have to kind of honor this check, or this person may be resorted to in case there is a dishonor or non-acceptance. Whereas an acceptor of honor is a person who voluntarily becomes a party to the bill as an acceptor. A person who has refused to provide some kind of a better security apart from the check can be someone known as an acceptor for honor. Let's look at the different types of bills of exchange. The bills of exchange, one, there is inland bills, that is inland bill is drawn or made payable in India, drawn in India but can even be paid in a foreign country. Foreign bills are drawn in basically not inland bills, they are drawn in a different country and usually paid in the foreign country itself. A trade bill are also what we call as credit bills. When a trader sells goods for credit, he may use this bill of exchange. An accommodation bill. An accommodation bill is one where a person who does not have good credit is using someone else's credit for the purpose of for the purpose of obtaining some kind of money from the bank. Let's understand this from this example. A is in need of money and he approaches his friend B and C, who instead of lending him money, give him an accommodation bill in the following form. If the credit of B and C is good, this device enables A to get an advance of 1000 rupees from his banker at a commercial rate of discount. The real debtor in this case is not C but A, the payee, who promises to reimburse C within a period of 3 months. Here the A is the principal debtor and B and C are merely sureties. What does this mean? Let's say there is a bank and the bank believes that the credit of A is not very good, and so they do not loan him any amount of money. So if A is unable to get the loan from the bank, what he does is he goes to his friends B and C. Now the thing is, for B and C the credit is good. Fine. So what the friends do is, okay, since the bank won't loan out to A, why don't you do one thing? Let the bank give 1000 rupees to A. Fine. But then the bank will treat B and C as the guarantors. So over here A is still the principal debtor. He is still the one who has to return this money to the bank. But then in case he is unable to pay back, the credit of B is good, so B will pay to the bank. So these people are something like guarantors. They are giving guarantee for the money that is being given to A. This is an action of accommodating A, or providing accommodating help, or providing some kind of a help to such person. So what they are saying is that the parties to the accommodating bill is the party lending his name to oblige the other party. In this case it can be B or C, and the party so obliged to the accommodated party, which is A. An accommodation party is not liable on the instrument because between them there was no consideration and the instrument was merely to help. But the accommodation party is liable to the holder for value, who takes the accommodation bill for value, though such holder may not be the holder in due course. In short, B and C will be liable only if A is unable to pay out the sum of money to the bank. The next is known as bills in sets. Generally, when certain bills are drawn, they can be subjected to loss, fire, destruction, or some other issues. So they are drawn in sets of 3. But remember, a bill of exchange, let's say that the first bill of exchange is 1 lakh rupees, but they are not sure if it can get lost or damaged. So what they do is they take out duplicate copies 2 and 3, both valued at the same 1 lakh rupees each. Okay, so you don't go and encash all 3 checks and get 3 lakh rupees, but rather as soon as you encash check number 1, these two become invalid and inoperative, because remember, they are merely duplicates. This doesn't entitle you to a lot 3 times the money, but rather only 1 transaction will be allowed. A bank draft is also where a bill of exchange is drawn between one bank on another bank or on its own branch and is a negotiable instrument. What do you mean by checks? Now, generally checks are a form of a bill of exchange. So, a check is a bill of exchange, but it is drawn only on a specified banker and it is payable only on demand. Please remember, a promissory note is an instrument which is paid by the maker, but then in a bill of exchange it is drawn by one person but paid by someone else. A check is a bill of exchange and the person doing the paying will be a bank only. So you can only issue a check if a bank has given it, and that check is only payable on demand. Only if you go to the bank and present the check to the bank will they actually give the money to you. A check also includes the electronic image of a truncated check as well as a check in electronic form. So what is a check in electronic form? It is a check which is using any computer resource or a secure system using digital signature, and a check is created. But then a check in truncated form is a check which is truncated during the course of a clearing cycle may be cleared by the clearing house. We already know that checks go through a process of clearing between the banks. Now, during this time, it would actually cause a lot of hassle if they had to take the check from one branch to the other branch. What if the branches were in 2 different states? So, to rectify the delay in actually taking the check and handing it over to the other branch or the other bank, they will simply take an image of the check and send it over to the other bank for verification. This helps in substituting further physical movement of the check in writing. It safeguards the check, and only the electronic image is used for the transmission. So, in this situation, we call this as an electronic image of a truncated check. So, what are the essentials of a check? It should always be drawn only on a banker. It can only be payable on demand. Okay. It does not require acceptance. It is a custom for banks to mark the checks and clear it for payment. A check can be drawn where the drawer has an account only. He cannot go to someone that he doesn't have an account with and take money. Checks may be payable to the drawer himself. I can simply write yourself for NEFT or yourself for withdrawal and withdraw money. The banker is liable only to the drawer and he has no other liability against any other person whatsoever. The validity of a check is usually 6 months' time, and no stamp is required to be fixed on checks.